One of the biggest misconceptions I see among successful business owners is the belief that high revenue automatically means you're doing well after taxes. It doesn't. I've worked with many business owners generating seven figures in revenue who are shocked when they finally see how much money is quietly leaving the business every year. Not because of mistakes and not because they did anything wrong, but because their tax structure never evolved as the business grew. When revenue increases, the IRS expects to see more structure, more consistency, and more intentional decision making. They expect owner compensation to make sense relative to profit. They expect payroll and benefits to align with income. And they expect the entity structure to reflect the size and complexity of the business as it exists today, not years ago. Having worked inside the IRS, I can tell you this. The IRS does not just look at how much money a business owner makes in a single year. They look at how income flows through the business year after year. They look at whether compensation decisions are consistent. They look at whether the overall picture tells a story that makes sense for a business operating at that level. Taxes are not just about totals on a return. They're about timing, structure, and patterns. And these decisions are rarely made in April. They're made months earlier, often without the business owner realizing how much impact they have later on. If revenue has increased, but planning hasn't kept pace, inefficiencies compound quietly. And once the year is in motion, many of those inefficiencies can't be undone. If your business is profitable, but your tax bill keeps climbing, that's not something to ignore. It's a signal. Call my office at 951-319-7674 today to set up a free consultation. Now is the time to reassess your strategy while meaningful options still exist before another year locks in outcomes you didn't intend.